Subir Gokan, former Deputy Governor of Reserve Bank of India, joins us on the show from New Delhi to talk about all of this. Really good having you, Mr. Gokan. Thanks so much for joining in. Now, two ways to look at it. 3.6% Q4 CAD, much better than expected. Some other markets didn't pay heed to it, maybe because they took into account the trade deficit numbers they came for April and May. I mean, how would you look into this data? And considering the fact that Q1 data, in all probability, will be worse off.
Well, I think the sort of relief that comes from this is that the high number of the previous quarter, 6.7%, may have been something of an aberration and not really indicative of sort of explosive growth in the deficit. So certain things changed obviously in Q4. Gold prices, oil prices, the currency is relatively stable. And all of that contributed to some narrowing, perhaps a convergence to a more sustainable number. Exports grew a little bit, imports declined a little bit. Of course, invisibles have shrunk from what I gathered looking at the report. So all of this adds up to some relief on the various pressure points that we saw in the previous quarter. But that's history. That's 3 months old. And in the last 3 months, many things have happened. The rupee has depreciated, so either the numerator is going to change if you measure it in rupees, or the denominator is going to shrink if you measure it in dollars. And so effectively, I think the anticipation that Q1 will have a worse number than Q4 is a reasonable anticipation. I think that's likely to happen. But whether the number will go back to that high of 6.7, I think that is another question. And maybe it won't. So overall, I think we should not take our eyes off this. It is still a source of stress. It is still going to have an impact on currency dynamics, particularly when capital flows become volatile again or remain volatile. And I think basically that suggests that we have to keep focusing on the structural drivers of this very large deficit, and comes down to how we're handling energy imports, how we're handling oil imports, and how we're handling minerals, which have become another big factor since we stopped exporting iron ore because of the mining restrictions, and we're importing more and more coal because of our own coal supply problems.
But just looking into the future, Mr. Gokan, now, what is the trend that you see on the CAD data? Because if you just look at the first 2 months so far on the trade deficit front, the numbers have not been very encouraging. And that just puts a question mark on the broad trend for the current account deficit. What is your estimate?
Well, I think we have to look at just focusing on the current account deficit alone. I think as you're saying, and I'm not really dabbling very closely, looking at these numbers very closely now, but the broad picture clearly is that this 3.6% may be somewhat of an overcorrection. It's probably going to be less than what it was in Q3, but it's not something. It would not indicate the end of the problem, which we typically would define as something like less than 3%. It's not going to reach that low. So in the above 4 is perhaps where it's looking, but I'm not making a very firm projection, and I'm just saying the 3.6 may be reversed somewhat in Q1. But I think the other thing which we have to look at is the other set of data that were released today, which is the debt numbers, the external debt position. And there I think we've got to start thinking again of the cumulative, the combined vulnerability that comes from both a high current account deficit and a high buildup of external debt. In particular, the proportion of short-term debt, and we're looking at residual maturity of less than 1 year, which is really the indicator of vulnerability, is now at close to 60% of the reserves, of the foreign exchange reserves. So that would suggest then that while we've been financing the big current account deficit by encouraging more and more debt inflows, over a period of time, this also builds up into another source of vulnerability. And I think we've got to be balancing out both the management of the deficit and the way in which we continue to finance it, even as we are addressing the structural problems. I think we have to be keeping our eyes on both these trends, both these patterns.
The other big concern, of course, no prize for guessing, is the currency. Now, yesterday we heard reports of maybe a mild intervention coming in from the central bank at around 59, 98 kind of levels. Not that it really managed to hold the slide. What happens? Because there's a lot of talk about we only having 7 months worth of forex reserves, and therefore major intervention by the Reserve Bank is not possible. And in all probability, the Reserve Bank doesn't want to do it either. What happens to the currency, and what happens to does the Reserve Bank take any kind of action to probably stem the fall of the rupee?
Well, there are really three ways you can address adverse currency dynamics in the short term. One is direct intervention, which clearly is an avenue down which the Reserve Bank has chosen not to go. And I think when we look back at the previous episodes in the last 2 or 3 years, that the view has been that if it's an irresistible force, if it's too strong to effectively manage with intervention, then it's not really worth drawing down reserves to do it, because as the governor himself has said, failed defense is worse than no defense. I think that's a very legitimate position. The other two methods, one, administrative controls, which essentially reduce the flexibility that different participants in the market have to exploit, to take advantage of currency movements. That was tried in 2011, 2012, and I believe some days ago a similar sort of restriction on cancellation, rebooking, and such flexibilities were imposed. And the third is basically what has been happening right through this period, the last 2 years, is look for at least some quick channels by which money flows in. So expanding the scope of foreign investment into debt, into equity. So a lot of that is going on. It doesn't guarantee the inflows, but when there is a return of flows to emerging markets, then at least you've created these openings, and that helps. But that then feeds into the issue I was speaking about earlier, which is that if you depend heavily on short-term debt in particular, while it may get you the inflows and help you to resist depreciation pressures in the short term, in the longer term you're actually increasing vulnerability, which in another episode, another shock scenario, would actually heighten and aggravate the pressures on the currency. So that's a very, very delicate balancing act that the management of the external sector has to try and achieve.
What about the global environment and that having an impact on the currency? We've already seen huge capital outflows. How do you read into all the talk about tapering, which can perhaps happen sooner rather than later if the data in the US continues to improve, and what that may do for capital flows to India?
Well, actually, as of today, I think that the lower than earlier published readings on US growth have actually allayed some of these concerns about early or quick tapering, because the growth number is 1.8 as opposed to 2.4 in the advanced estimates. So I think that's a process that will unfold as we go along. Today, as of today, it seems that the prospects of it coming to an early end have gone down somewhat, which has obviously encouraged markets. But what has happened in the last 2 weeks, I think, is essentially a repositioning of global portfolios. The news that the liquidity infusions would actually stop sometime in the near future, perhaps the end of 2013 or early in 2014, has actually caused all investors to sort of stand back, take stock, and when they do that, they basically are pulling money back into the safe haven assets, essentially US Treasury bills. And that means the dollar is going to appreciate and all other currencies are going to depreciate. So we've seen that, obviously, in that process, countries which have large vulnerabilities, as we do through the current account deficit, will see more depreciation than others. And we've seen that process play out as well. Now, the follow-up to this will be a global reallocation. I mean, people can't sit on these positions forever. Now, when that happens, I think we've got to be very conscious of the fact that money coming back to India will depend heavily on what we've done to address some of our stresses, what we're doing structurally to narrow the current account deficit, what we're doing structurally to recreate a positive investment climate. All of these things will be observed, all of these things will be watched, and all of these things will have an impact on how much money comes back into India after the reallocation, or as the reallocation is being done. So we cannot again afford to slow down on all of these adjustments, these structural processes, because the money may have gone out now. When it comes back, it will be looking at the progress and the momentum that we are generating on those issues.
Mr. Kokran, before we let you go, sir, how does all of this translate or influence the RBI's outlook on rates?
That's not something I want to comment on directly, but broadly speaking, if you look at the last statement, which is just about 10 days old now, the fact that there was no action then was essentially justified by the offsetting impact of currency movements on the growth slowdown, and basically these two factors were in a sense cancelling each other out. So I think that argument, that logic will continue. If the currency shows this persistent weakness, and as a result of which imports, particularly of energy and other commodities, become more and more expensive, that is going to add to inflationary pressures even as growth is slowing down or stabilizing at a relatively low rate. So I don't think the issues that were raised or the dilemmas that were raised in the June 17th policy, the mid-quarter review, are going away anytime soon. And so I think that's going to condition the process. So if the other offsetting factor that one might see, but there aren't very strong signs of that at this point, is if in the process of reallocation, of global portfolio reallocation, commodities experience a sharp fall. We've seen some softening of oil prices also, and other commodities have been going through a softening process for some time, but oil prices have started to show some softening. They moved down to $102 a barrel on the Brent, but that's not dramatic. That's certainly not enough to offset the inflationary impact of the lower rupee, which has depreciated much more than that in relative terms. So I think those are going to be the factors that will continue to influence thinking on monetary policy.
Great. Mr. Kokran, really appreciate you taking the time out and being with us and sharing your thoughts on all of these key issues. Thanks much, and look forward to have you more often on this forum.